Welcome back to the Investment Conversation. I'm Andy D'Souza, partner and chief marketing officer here at Lord Abbett. Today, we're discussing a hot topic in the news, the convergence of the public and private credit markets. And I can't think of two better guests to join us than our very own Vince Liu and Kearney Posner, both partners of the firm and portfolio managers. Vince, welcome to the show.
Nice to be here, Andy.
And Kearney, welcome as well.
Andy, a pleasure.
Great to have you. All right, let's get right into it. So headlines out there on the convergence of public and private credit markets. We've seen all three markets, we should say all three asset classes within leveraged credit grow over the last 10, 15 years. Private credit, probably the most notable. In 2010 was around 300 billion in size. Today it's about 1.8 trillion, on par with the size of the bank loan, broadly syndicated bank loan market, the BSL market, and also the high yield market itself. So I guess maybe a first question for you, Kearney, why have these markets grown so much in the last 10, 15 years?
Yeah, I think you highlighted that they have all been growing, right? So we've seen high yield market double. We've seen the broadly syndicated loan market triple. And I think we're now at quintuple or more on the private credit side. I think that's driven by a couple factors, right? So I think one, given low yields and then very volatile and higher yields, there's a demand for floating rate paper. So we've certainly seen a lot of investors look to hedge their portfolios with floating rate paper in this interest rate environment. I think two, we've had one of the largest, longest expansions in our history, 10 plus years since the GFC, and there is a demand for yield, and so a demand for leverage credit in particular. And then I think the third big factor as I look at it is really the growing complexity of our markets and how do we best serve the various demands. And so all of these offer slightly different solutions to solve borrowers' problems. And so I think those have all contributed to growth across all three markets, certainly private credit being the largest, Vince.
Thank you for that, Kearney. But why Vince, in your mind, as the private credit market or direct lending corporate credit, why has that grown the fastest recently?
So there's been a number of factors. If you look at it from the investor perspective, what you'll see is that the asset class, if you can afford the illiquidity associated with buy and hold paper, that you can generate around 150 to 200 basis point incremental yield relative to the liquid markets. And that's because these securities are generally illiquid and there's not much trading activity. That's attracted a lot of capital into the marketplace as sophisticated investors have understood the benefit of being able to create a core holding around that. And so that's created enough capacity to be able to serve both traditional middle market companies, which is really where private credit started, and now into the larger end of the market as more and more capital has come in. From a borrower perspective, there are a number of advantages that offset the incremental cost. One is speed and certainty of financing, going directly to your lenders and knowing in advance what pricing and structure for your deal could look like. Number two, you have increased confidentiality. You have the ability to tailor the financing solution directly to your needs. And then you also have a good working relationship with your lenders over time as they stay with you during the life of the loan.
And I guess if you're a CFO at a company, you're looking at one of these three markets for funding, whether it's the high yield market, the broadly syndicated loan market, or it's the private credit market, why would I, as a CFO, choose one or the other, or maybe multiple options here? Any thoughts on that, guys?
Sure. I think you kind of start with what are you trying to solve for? Are you trying to solve for best execution? Are you trying to solve for flexibility in terms of features for your credit? Do you have a view on rates, whether it's fixed or floating? All of these are incredibly important factors. Also, what's the nature of your company? Do you generate a lot of free cash flow? You want to value prepayability, which tends to come in floating rate versus fixed rate, where you might have a lot of upfront expenses. So all of these are incredibly important as CFOs think about what is the best tool to optimize. And really, we're presenting a suite of tools for them to reach those goals.
I think Kearney's covered all the important points. I'd add on one additional point on top of that, which is really tied more towards a private credit solution. And one of the things we find when we talk to CFOs is what they really value is the ability to pre-commit to additional capital in size over multiple years to be able to pursue whatever strategic initiatives they may have. That could be unidentified future acquisitions, it could be large upfront spending that you're required to do in order to secure new and important customers. And from my experience in sitting in a number of different board meetings where these things are being debated, that the strategic importance of those types of initiatives and having the certainty and knowing that you have the capital to support them is oftentimes more important than the cost itself. And so we find that the most strategic CFOs out there look at the whole range of options that are out there, a lot of the factors that Kearney has mentioned, but the ability to pre-commit additional capital is also a very important consideration.
Got it. And if I'm a CFO, then when I'm looking at the different options, the factors then lead me does it lead us towards certain industries that may because the convergence of the overall markets is one thing. Does that mean that there are certain industries specifically that would actually look to the either BSL, high yield, and or private credit market? Are there some overlapping industries here?
Yeah, I think one of the big ones that's certainly been the headlines recently has been software.
Sure.
Because of the historical multiples, there's a lot more flexibility to put leverage because the free cash flow profile is very robust. And so when CFOs think about debt prepayment and their capital structure, the ability to prepay debt at par versus 103 or 105 call premiums is very valuable to them. Also, a lot of these companies are private. So, what the BSL and the private credit markets offer is a little bit more privacy in terms of the financials for competitive information. So, that's incredibly valuable for these issuers as well. So, I would say software is certainly a big one. Similar profiles, I would say, is also healthcare and services. Whereas you tend to see more capital intensive industries go to the high yield market because there's less free cash flow upfront and prepayability is not as valuable.
And I would just add on, I think Kearney and I think very similarly in terms of our investment philosophy as a lender, where your upside is really capped at par, maybe a small premium on top of that. We really like focusing on defensive industries, areas where you don't have a lot of cyclical exposure, healthcare, as Kearney has mentioned. For us on the private credit side, we do a lot in waste management. I know Kearney likes that sector as well. Software, we've been very underweight to,
Mhm.
on the private credit side, although much of the private credit market has been very focused on that segment. And the reason that we've been cautious around that is as a buy and hold lender over the 3 to 5 year period, it's really difficult to predict where technology is going to be. And if you can't do that and you do get it wrong, your recoveries on those types of loans could be very low. And that can be in a capital preservation strategy, a very difficult sector to lend behind.
Can I just dig in a little more there on the you mentioned as a buy and hold lender. So there are a lot of similarities between the two markets and the borrowers that you're evaluating uh, continuously in the marketplace. When it comes to let's take software for example, how do you look at the underwriting of a software loan, and how do you maybe differently, or what? How do you think about those when you're looking to lend money to a company? And maybe Vince, to your point about 3 to 5 year, how do you think about lending money to a company in general, basic terms?
In terms of the software lending activities that we do, we really look at 8 different criteria that outlines the parameters around which we want to lend to a software company. What we're looking for is staying power of those companies through the cycle over a 3 to 5 year period. So we're looking for mission critical status. We're looking for a market leader. There's a whole bunch of different considerations that go into the evaluation of a software loan. What becomes difficult for us is that if you do get one of them wrong and you have a competitor that leapfrogs you in terms of technology, it can really be severe impact on the overall business. And that's led us in, for the most part, to stay away. But in the right situations, we will do software deals.
Yeah, so maybe just to build upon that, as been said, similarly, we are more defensively postured in that space versus the index and some of our peers. We started moving probably a year and a half ago to more of an underweight position as the threat of AI increased. Uh, what we think about and what I think is different in our market than say yours is we can be more tactical. we can be more nimble in terms of views. So we don't necessarily need to have a 5-year view. We can have a view that this credit is able to free cash flow. They're pretty defensive. They have proprietary data, network effects, a lot of the key variables we look for as we assess them, and that they can refinance their debt in the next 1 to 2 years. And so we're able, because we have more liquidity, to be a bit more tactical in the space while still remaining very up in quality and defensively postured.
Vince, you mentioned a buy and hold viewpoint. So I guess when we're thinking about underwriting the different borrowers, and specifically in software, maybe yours sounds like it's more of a underwrite to maturity, or can you maybe a little bit different
Mhm.
in the BSL space? Can you just talk about that real quickly for me?
Sure. So for us, typical maturity on a loan is anywhere between 5 to 7 years. And as a buy and hold investor, without having the ability to trade out of our securities, we have to take a view on where the industry and where the borrower is going to be over a 5 year period. And because of areas like software, very difficult to predict where technology is going, it becomes a very, very difficult industry to underwrite over that type of time frame. And as a result, we've been very underweight software in our own portfolio. There have been a few situations where we think we found borrowers with very, very good staying power through cycles that we'll invest in. But in general, it's a very difficult industry to invest behind.
Yeah, it's not just similar from what we've seen in other industries, right? So it was telecom back in 2002, energy back in 2015, retail in the late teens, where there was some secular change. And what you typically see here is that it's not all at once. It tends to have waves to it. You have the early losers, then you have like Amazon continuing to encroach, and some can adapt, like a Best Buy, and some can, like a Circuit City. And so I think this will play out over the next 5 to 7 years. But as we think about certain catalysts, I would say the ones that we're thinking about is really around the next refi. So where do we kind of think about the leverage point and what the market will accept as the risk profile for these names going forward for some of these shorter dated maturities? And then we think about a lot of these have annual renewals. And so the next renewal cycle will probably be towards the beginning of next year. And what does that look like? Are we going to see the churn that the market is really fearing? Or, as I suspect, a lot of these are much more entrenched and it'll be a much slower melting ice cube. And so as we think about catalysts, those are the key ones that we're really honing in on.
When you say next refi, you're referring to in headlines when I put a finer points on it. When I hear, this image, and it happens to your point about cycles. I read this in the press every 5 to 10 years. There's a giant maturity wall coming. Look out!
Yeah.
And it seems like there's always a maturity wall. We never actually have slammed into it. Feels like is this time
Yeah.
different, or what do you think? How do you think about the maturity wall?
Oh, I think it's a question I get asked almost every meeting about the maturity wall. We haven't had an issue with maturity walls yet, and what I do find is that the market tends to correct itself. It tends to find the clearing price. And so, as you mentioned, we do have a software maturity wall. We've got about 20 billion coming due in 2027. Now, keep in mind, we're looking at a $1.5 trillion market. So that's around 1% of the market, which isn't too meaningful. It does get slightly larger. We're looking 60 billion, 70 billion in the following 2 years. And so as I think about those catalysts, really addressing one of those 27s and seeing how the market prices that, how the market structures it, will be a clearing event in my mind for how we think about valuations for these software companies to come.
And when I guess maybe taking a step back a little bit here and thinking about just the interplay, having the three, I should say, asset classes under one roof here at Lord Abbott. What do you take away from each other's markets when you're looking at underwriting or even a loan in the marketplace? Are there certain like signals that you can see when looking at one another's marketplaces, and what can you share about that collaboration?
Yeah, I from my perspective, the addition of Vince and his team has been incredibly additive. Perhaps less so from the signaling perspective, but really from the sponsor access that we're getting for our companies. So I think it's important to keep in mind that roughly 70% of our loans are private, so they tend to be sponsor backed.
Hmm.
So having relationship with the sponsor to get management access, to get better allocations on well liked deals is incredibly important. It has been very meaningful and material for us.
And for us, being part of a platform that has both public and private credit capabilities is a real big benefit. And I'll go through a couple reasons why that's the case. But maybe I'll just start by saying, we look to the public markets for signals, as you had mentioned, Andy. But it's really important for us to recognize that the market can move a lot for a variety of different reasons, including both technical and fundamental factors. And what we try to do is separate that signal from the noise. On the technical side, that's the type of stuff we try to ignore. Inflows and outflows in and out of high yield funds and loan funds can move the market along. We try to ignore some of those technical factors. And what we really try to do is spend our time looking at the fundamental factors that we can capture from the public markets, information from earnings reports, from investor calls, where there may be forward-looking information on where an industry is going, or just general news and developments that can help us better understand particular industries. All of that information is captured by Kearney's team on the public side through 9 industry chats. It's something that our private team subscribes to, and gives us real-time access to shared data and insights across a broader platform, which is a very big benefit for us as we go through our investment underwriting process on any particular deal.
So then if I shift it again from the perspective inside the walls of Lord Abbott back to I'm a CFO now at a company. Now I'm seeing public markets and private markets where I can look for financing. I have the optionality now to do that. So I guess is it more of a competition or cooperation? How do you think about that environment?
I think it's evolving. So I think there is a period of time where we saw a lot of growth in private credit. There were extended periods of volatility, whether it's the GFC or COVID or even the 2022 inflation, Ukraine war, where private credit really rose and ascended. Um, and then I also think there was a period of time where most people were one or the other, right? So it was a zero sum game. I think what I've seen evolve to is now it's a suite of capabilities. The banks aren't just doing broadly syndicated, they're also partnering on the private credit side. So it's become much more complementary. In fact, we both participated in that deal a couple years ago. There was an insurance broker that there was a private credit component and there was a broadly syndicated component in the same loan. And I thought that was interesting. And we kind of talked about what that added from the issuer's perspective of having access to multiple different venues. They have the private credit as well as the broadly syndicated, which provides both an avenue for going further into the public markets, potentially IPOing down the road, and or having access to the private markets if there's another period of volatility and they need to issue to acquire another company or the like. So I find it very interesting that it's really become a suite. There's less direct competition, less of a zero sum game. Um, but we still compete on some deals.
Yeah, I would add on top of that, before I joined Lord Abbott, I worked for the asset management division of a large investment bank. And just to give you a perspective, I felt like I had an inside look on how a bank looks at corporate relationships.
Hmm.
And what you would be interested to know is they look at the lifetime value of those relationships, all the different services that they could sell to that borrower over time, debt and equity financings, M&A, FX, cash management, hopefully not restructuring services if they get it wrong, but it is how the bank thinks about it. And so the banks who are underwriting a lot of these and arranging a lot of these financings, they really don't want to lose that corporate relationship. And so one of the things I found is that they're trying to position themselves to make sure that they don't lose that debt financing mandate, because if they do, they lose pole position on all the other financings. And so that at that level tends to create a little bit more competition.
Mhm.
If you have a private credit lender who has put very aggressive terms on the table, you might have the underwriter come back to the table and say, I'm going to push leverage a little higher. I'm going to tighten up pricing, loosen up documentation. It's part of the reason why we think that part of the market has good balance, but is very competitive. Part of the reason why we like to participate more in the core middle market, where we think that the waters are safer and calmer.
And you mentioned, you know, loosening up of documentation.
Mm.
I read that as, or I hear that as the evolution of covenants over time, maybe?
Yeah. Yes.
Right?
How have they evolved? How are they evolving now?
So we do spend a lot of time looking at covenants in the core middle market and below. You generally will get financial maintenance covenant in the right situation, which when you actually look back at the history of recoveries, Standard and Poor's puts out some interesting data that shows if you do have a financial maintenance covenant to protect you, the recoveries are 20 points higher. And that's because you can get to the table earlier, work together with the borrower to come up with a solution, maybe try to bring in junior capital. But for us, covenant protection is important. No question about it. Kearney's absolutely right. At the upper end of the private credit market, you tend not to have those covenants.
Mhm.
The good CFOs out there will play one market off against each other. And if you're a private credit lender, the most likely thing you're going to hear from that CFO is, I can do a covenant light deal potentially in the broadly syndicated loan or high yield market. Why would I ever agree to a covenant in a private credit deal?
Yeah, and I would say that's actually more of the norm now. They're dual tracking, what can I get in private credit? What can I get on the public side? And doing the cost benefit analysis. Like there's a cost to getting ratings, there's a cost to kind of going through the agencies and whatnot. And so sometimes even though it's a higher cost, it's they prefer the flexibility for not much more in terms of coupon.
So you mentioned like for the optionality, there were some industries that are sort of more in common with both of the asset classes. Some of healthcare, software, some of the defensive sectors out there as well. What about from a you mentioned the core middle market was the term you used, Vince. Maybe you could just help us define that a little more, how you see the core middle market. And then do either one of these markets service different, is the size of the market or the EBITDA, for example, how does that play into the convergence here? Is there a convergence at the upper end, the lower end, the middle? How does that work?
Sure. So the way that we define the core middle market, as you had mentioned, Andy, is based upon EBITDA or cash flow of the business, annual cash flow. And we define that anywhere from 25 to 100 million or so. Those are a bit arbitrary numbers. I think others out there use slightly different numbers. In that part of the market, when you extrapolate it, generally speaking, those companies don't have access to the public markets. And the reason for that is that the public markets like to have minimum issue sizes to be able to actively trade in and out of bank loans or high yield securities. And if you're too small, that really doesn't appeal to that segment of the market. And so, with that kind of delineation, where we see most of the convergence is really at that upper end of the market, 100 million and above, where you have borrowers tapping both the public and the private markets.
Yeah. You know, as a large issuer, if you're looking at a $300 million deal, you might not be able to get enough allocation for that to be worth the time and energy versus, say, looking at a several billion-dollar deal. So we tend to focus on 500 million and above because you've got a diversity and you have liquidity that we really seek in general.
Another maybe more specific example that I think I've heard you both talk about was, you're seeing signals and from each other's markets. You may be getting relationship, advantages by being on offer firms, multi or dual tracking of debt. The other one though is sometimes maybe Vince in your world, sometimes you actually may employ the use of a straight BSL loan in your portfolio, and you can then I think lean in and tap into Kearney's team and their expertise for that. Is that right?
That's absolutely right. And it's a big benefit for us relative to our middle market competitors who might not have that same platform. So we will occasionally invest in broadly syndicated loans for both opportunistic reasons and to be able to go to Kearney and her team who cover 1,200 broadly syndicated loans. I think it's a number like that. It's a gigantic number to tell us, where are the best names and the risk reward type profile we're looking for is a big advantage. That's certainly something we couldn't do on our own, and it's been very beneficial for us.
Yeah.
Community, the market is in the BSL. It's a large market, as Vince just mentioned. Has the quality of the market changed over time?
I would say the constituency of it has changed.
Okay.
So we used to have a lot more overlap with the high yield market. So probably a decade ago, there was 60 to 65% overlap of issuers. That has come down. So we're closer to 40% overlap. A lot more private issuers come to our market and only to our market. And as a result, what you're seeing is we're seeing a shift in the ratings profile from where it was, say, a decade ago. We're probably solid single B, where there was a little heavier mix towards double B in prior years. And this goes to the nature of the sponsor backed and the LBO versus public company that you see much more public companies on the high yield side. So it does present opportunities for us. It also presents risks. Higher rates are both a good and a bad thing. Higher rates mean you get more interest income. Higher rates can pressure higher levered companies more, but it does present us overall, I think, with an interesting and attractive diversity of opportunity set, by having the growth that we've seen, the issuer development we've seen, and kind of the shifting mix that we've been seeing as well.
We're talking today a lot about the convergence of public and private, more specifically between the broadly syndicated loan market and the private credit direct lending market. But as you point out, there's also overlap in the space here, the Venn diagram with the high yield market as well.
Mhm.
I guess if we're talking about the asset classes that you're each responsible for, here at Lord Abbott, what's sort of one misconception? Maybe I'll start with you, Vince. What's one misconception about your asset class you want to set the record straight on here today?
So I would say thank you for asking that question. There are a lot of
Just give
misconceptions
me
out
one.
there,
Just
right?
give me one.
And I will try to stick with one. I would say that the biggest narrative that may be out there that is just not true is that investors who are investing in the private credit asset class could be potentially facing large losses given some of the activity that's been going on in the software market, some of the redemption pressure, and some of the private wealth channels with capital coming out. And all you need to do is go back and look at the data, and you can see senior secured loans generate somewhere between 70 to 75-cent recoveries because you're at the top of the capital, you're both senior and secured, and that even if you apply, a peak default rate that you saw through the global financial crisis, you're still going to generate a mid-single digit return. So no question about it, there's going to be greater dispersion of performance amongst managers, particularly those that may be more heavily weighted into software. But in general, the asset class with a good manager behind it, very stable, with very good downside protection associated with it.
And so I guess this next question will be the last question for each of you. I think I might know the answer, but maybe not. Let's see. If we think about the two asset classes that you're responsible for again, so broadly syndicated loans versus direct lending, private credit. If I'm an investor now, so we talked about the viewpoint from the Lord Abbott's perspective, running the actual portfolios and lending out the capital. We talked about the borrower's perspective and the whole convergence play. Now, if I'm the investor investing in the asset classes, is there room for both in the portfolio? Is one better than the other? Which one's your favorite?
So maybe I'll start. I would say there's room for both. I'm not going to answer the which one's your favorite.
There you are.
But if you can afford a little bit of illiquidity, we think there is a room for private credit. It's demonstrated in the past incremental returns relative to the public markets. But at the same time, the public markets are a very good market as well.
Yeah, I would echo that. I'm also not going to reveal my favorite, but I would say there is a bit more of a strategic versus a tactical element perhaps to think about. I think there's a place for both in the portfolio. I think you can take advantage of certain dislocations in the market more easily. So it really depends on your timeline and your risk appetite.
Of course.
And I would also maybe just add on to that, Kieran, one of the benefits that I feel we have in terms of an integrated platform with both public and private, it's a big theme that you've talked about, Andy, of the convergence of the two markets. We already work pretty closely together. It's going to be even more so going forward as these markets just come together.
Vince, Kearney, thank you for your time today. Really appreciate it.
It was a pleasure. Enjoyed the conversation.
Same here.
Thank you for listening to the Investment Conversation. Find more episodes wherever you get your podcasts or at lordabbott.com, and follow us on LinkedIn, Instagram, and YouTube for more perspectives from across the firm.
Neither Lord Abbott